Hello, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope all you guys had a very good day of trading today. And in today's action, guys, well, we almost had a fifth day in a row of declines as the tensions for the Trump tariffs continue to mount. Google laying off cloud employees as well. NVIDIA coming out with their earnings, and the stock is barely moving too. All of this combined, guys, leads to a lot of uncertainty in the markets as the fear and greed index hits extreme fear for the first time in a few months now. So, is it just an overreaction, or possibly the beginning of something worse to come? We're obviously going to take a look at that in today's video. So in today's video, as a matter of fact, we're going to take a look at a few key metrics together. Number one, we're going to be going over a ton of earnings reports together, and those are going to be NVIDIA, of course, Salesforce, and then take a brief look at Lowe's and Home Depot, see how those held up amidst the consumer concerns in terms of discretionary spending. Thereafter, guys, we have to do a ton of technical analysis, first on our major market indexes, the SPY, the Qs, the other major indexes, see how the rotation is shaping up. Where is the money going? Because it's definitely not going into big tech right now. Thereafter, guys, we're going to take a look at the big tech names specifically, see whether or not some of them are at very decent buying opportunity levels, or is it more cautious to wait? And then lastly, guys, take a brief look into my portfolio to see how I am positioning amongst all of the volatility right now, which trades I've put on for the week, and which trades I am keeping in the portfolio for a medium to long-term swing. So all that being said, should be a very interesting video, but it might be a bit on the longer side because there's tons to talk about, and I missed you guys. We haven't seen each other in the last 2 days, so let's start it off, shall we? So the SPY up about 0.05% today, the Qs up about 0.24%, but you can see the futures markets overnight have largely erased those green candles overall, and we might just be heading lower for the remainder of the week as the downside continuation simply proceeds forward. So in terms of rotation, guys, take a look. Well, it was not the best. Big tech had a bit of a bounce today, but most of the bounce, in my opinion, was a little bit of short covering. We have not changed the lower timeframes at all, and the bears still remain in short-term control. The weekly and monthly timeframes do not look too bad, as we'll take a look at in about 10-15 minutes in this video. But overall, guys, not a very healthy day in the markets, to say the least. Consumer defensives continuing their declines, financials and healthcare even getting dragged down in the mix, and even the bottom half of the market, which has been more resilient than not recently, was dragged down in the mix as well. On the one-day relative, you will see that even better. Although it does say that half the market was up, we were barely up. And to the downside, consumer defensives, healthcare largely dragging everything down further. On the 1 week, it is looking quite bleak, to say the least, guys. Almost every single major index in the market was down. Only gains to be had was in real estate and healthcare overall, which leads us to a 1 month relative. After only 5 days, we are now officially in correction territory. Not quite for the SPY just yet. For the QQQs, yes, off the all-time highs, you will see right there. That is a drop now to the lows of about 4%. Correction plus is 5%. The Qs have already done it largely, guys. The Qs top to bottom over 5%, officially in a slight correction territory as of now. Very fast, right? Stairs up, elevator down, reminiscent of all the volatility catalysts that we've had over the month of January and even in the month of December so far. Now, really coming into the February months as well, and possibly even for the month of March. It is a battle of narratives right now, which we had in described in the Monday video session, right? The narratives are very simple. The economy, the jobs market, and all economic data point that the economy is still strong and still more resilient than the media will lead you to believe. But we all know the market is based on future expectations, and with the most recent consumer sentiment and consumer confidence reports, consumer sentiment is not very good right now, and even some analysts on Wall Street are leaning towards the possible unraveling of the US economy because of the impending trade war if the tariffs are maintained for long enough and consumers really start pulling back and readjusting their spending, right? Well, that could lead to a little bit of a stagflationary environment whereby inflation stays somewhat sticky and growth in the economy somewhat slows as well. That is arguably one of the worst case scenarios for the market, because if that happens, the Fed really doesn't have any tools to combat stagflation. They can't cut rates because inflation is still high to stimulate the economy, right? And quantitative easing, you can forget that. They're not going to turn the money printer on unless things get very, very, very dire. However, the solace is in the fact that most of the companies that have reported earnings so far this year have said that the guidance for 2025 should remain quite good. Corporate profits are at record highs. We are not seeing any signs of massive layoffs just yet. And overall, we get a nice GDP print tomorrow. And the GDP expectation for tomorrow, guys, is 2.3%. That does definitely not show that the economy is very weak. But as we know, guys, the market, although largely based on fundamentals, is also a game of narratives. And right now, the narrative is Trump equals bad for the economy, even though the data does not show and support that yet. That is what the market is running off of. So rather than trying to predict the direction of the market, we just play the narrative for what it is, which means that right now we should be playing defense and being a little bit cautious in terms of the trades that we do take. More specifically, yes, tech is a very decent buy right now, but you may need to extend your horizon. I'm not looking for a snapback recovery in big tech names. A lot of the money recently has been pivoting to more predictable and value-oriented names, and we also seen a big uptick in bonds. That being said as well, take a look at the Fear and Greed Index, now clipping into extreme fear reads, as we have now lost all of the momentum over the past week and a bit. Extreme fear on market momentum, extreme fear on stock price strength, meaning net new 52-week highs and lows on the New York Stock Exchange, nothing almost hitting brand new highs, everything kind of clipping down and tapering back as investors really start tapering back their expectations as well. Stock price breadth has now curled over and coming back into a decline reminiscent of the one we had late December prior to and after the Jerome Powell incident on December 18th. And the put to call ratio has been spiking as well as investors seek to buy insurance and protection for uncertainty. And the key word is definitely uncertainty, guys, because we do not have hard negative recessionary data just yet, but we do have high levels of policy uncertainty. So people are buying protection for that overall. So that is a quick little recap of the market rotation. You can also take a look at your breadth indicators, the percentage of stocks above their 20-day moving average, back down to a very low read of 30. When we get to 30 and below, it is synonymous with a buying opportunity in the market. Take a look at the percentage of stocks above their 50-day moving average, only 40%, not as low as we had late December and early January. But if we do come down into the mid-30s to low 30% range, that is when you know that, coupled with extreme fear reads in the market, is a decent opportunity to buy. But are we going to blow the entire bag in one single purchase? No. We want to be periodically buying very high quality companies at attractive prices and just building and building and building those positions over time. So do not spend all the buying power in one single day, guys. It could be very volatile. I've been saying this on the channel since January, that January and February trumps the first 30 to 60 days could be extremely volatile to say the least. And percentage of stocks above the 200-day moving average continues losing ground. We are now still roughly in line with the lows that we've had over the course of 2024. These have all been synonymous with buying opportunities overall. I know it does not feel like it right now because as soon as the market starts dropping, people start expecting the absolute worst. You expect the markets to really fall through the floor. But overall, I do not think we have the catalysts right now for the markets to really fall through the absolute floor, similar to what we had in maybe a 2008 or a COVID crash 2020 or an interest rate cycle hike, which was 2022, where companies were revising EPS estimates down. They were laying off employees as well and revising corporate profits to the downside as well. We do not have that recipe just yet for a market disaster, but a pullback, a correction because of high levels of uncertainty, that of course is definitely on the table. So that is your introduction for today. Before we get into more technical analysis, let us dive really quickly, well, not really quickly, but let us dive into NVIDIA earnings. Going to start off with a banger for the biggest one of the bunch, NVIDIA earnings. And just at face value, guys, let me just start off by saying they absolutely crushed it. But we know how picky Wall Street has been with these tech earnings and a lot of earnings so far this quarter, and this one was no different. In spite of the fact that NVIDIA posted amazing quarterly earnings and raised guidance for the future, still it was not enough. I've been talking about this on NVIDIA for the last 3 quarters right now. It's a question of them being their own worst enemy. They have very tough prior comparable numbers to put up. You know, oftentimes in the past year, 2 years, we're growing at triple-digit clips, 100, 200% plus, and now we're seeing the growth rate normalize to say the least. However, fundamentally, I do still think right now this company is a very attractive buy. However, the name of the game for this video, we are going to focus on predictability, right? Because what the market wants in an uncertain environment are companies that have very predictable streams of revenue. There's only one problem with NVIDIA right now, which is preventing the stock from running. It's we do not know how much and for how long big tech is going to continuously spend on these data centers and on ramping up their AI production capacity, but also their data optimization capacity for those data centers, right? We know for a fact, by far and by large, data is pretty much the new gold of this era. And we have the largest cloud providers in the world, Microsoft, AWS, and Google, all pushing forward, right? Not every single company will be able to host their own data centers or have their own data centers. They will have to rent that space from these large tech companies, and that demand will only increase over time, which should translate to more and more gains for NVIDIA. This is the medium to long-term picture. But in the short term, what's affecting NVIDIA is, of course, the news surrounding DeepSeek, the news surrounding potentially Microsoft pulling back on spending, even though they dispelled that article that came out shortly on the Friday session into the Monday session this week, right? There's a lot of timidness, a lot of uncertainty surrounding that big tech spending. How much will it be? How much can you forecast it to be in the next 2-3 years? We know this year it's going to be big, but are they going to fully pull back? And in the event the economy starts to kind of tailspin into somewhat of a soft-based recession where growth kind of tapers back, inflation is high, consumers spend less, and then businesses start spending less, could we maybe see a period in time where these companies pull back their spending for potentially a 6 to 12-month period as they hoard cash and try to make it through some form of a downturn, either in the consumer or in business spending? Yes, probably. And that is why you're not seeing NVIDIA fly, for those two reasons. Number one, concerns around the continuity of that CapEx. And number two, of course, simply just the fact that NVIDIA is its own worst enemy. It's looking at very tough comparable year-over-year numbers. So all that being said, that introduction, let's get into the numbers, and you will see they're actually fantastic, right? Beat on EPS again by 5.3, beat on revenue by 3.23. Now let's take a look at the earnings presentation overall. NVIDIA sales grow 78% on AI demand. Company gives strong guidance. Now 78%, face value is a very strong number, but it is not the 200 plus percentage points that we were used to in 2023 and the 100+% that we were used to in 2024 as well. The growth is normalizing, but objectively, you'd be hard-pressed to find any company growing at 78% year over year in terms of revenue, and especially in terms of the AI niche. Moving forward, the company's report and guidance signals that the chip maker is confident it will be able to continue its historic run of growth driven by AI well into 2025. This is not new. Jensen told us this last quarter, so happy to see that that is still indeed the case, and I would have been highly surprised if it wasn't, with big tech raising its CapEx guidance for the year already. Moving on further, right? They beat on revenue and EPS, which you already covered. They expect about $43 billion in first quarter revenue, plus or minus 2%. That is a beat on the estimate of 41.78. So double beat here and raise of guidance. The first quarter forecast implies year-over-year growth of 65% from a year earlier, a slowdown from a 262 annual growth clip in the same period last year. There's your tough comps. CFO said a significant ramp of sales of Blackwell was underway in the first quarter. The net income, this is insane, rose to $22.09 billion. That is 56.1% net margins. If you take a look down here, on the right-hand side of the screen, you'll see that NVIDIA is no stranger to high levels of net margin profits, oscillating between the 57 to 55% range, and this quarter was no different, coming in at 56.1. They make a ton of money on the bottom line. Now, here's one of the pain points of the report, right? And they reported a 73% gross margin in the quarter, which was down 3 points on an annual basis. If you wanted to pick apart anything in this report, it would be on the gross margins. Now, that did not really affect net margins, to say the least, but it was one thing when coming down on gross margins. The reason being, they have newer data center products that were more complicated and expensive to produce. But all in all, guys, for a product and hardware company to have 73% gross margins, that is almost similar to software as a service companies. You're not usually used to seeing hardware companies with this high gross margins, especially not in the semiconductor industry. The only one that's comparable is Taiwan Semiconductor that has an actual physical product to deliver, right? Now, The full fiscal year revenue rose 114% to $130.5 billion, which is absolutely fantastic as well. They said they had $11 billion in Blackwell revenue during the fourth quarter, starting to ramp that product really well. Jensen obviously said that Blackwell is amazing in a statement, and the CFO called it the fastest production ramp in our company's history. So they're doing the best they can with the tools they have at their disposal, and I think they're ramping this product very well. Blackwell sales were led by large cloud service providers, which represented 50% of our data center revenue, meaning the big four companies, guys, Meta, Amazon, Google, and Microsoft, 50% of overall sales. Of course, some of those are also going to Oracle and a few other key players in the industry, but for the most part, the big tech names, many of the names of the Mag 7, and you can obviously include Tesla and X.com in that as well. They are a very large client of NVIDIA. Suffice to say, they are the major players in terms of clientele for NVIDIA. The data center revenue increased about tenfold over the last 2 years. NVIDIA said it has $35.6 billion in data center revenue in the fourth quarter, which was up 93% on an annual basis. That data center business for them is their bread and butter nowadays, of course, and that the data center revenue surpassed the guidance or the estimate from guidance by about $2 billion. They literally beat everywhere, guys, except for one little segment, which was the gaming segment. NVIDIA officials told investors that while its chips were previously used to develop or train AI, its new chips, such as Blackwell, will be used to deliver AI software, a process often called inference. Now, new ways of running AI models that ask the AI to generate additional information to think through responses could require as much as 100 times the amount of NVIDIA chips. That is absolutely insane. Long-thinking reasoning AI can require 100 times more compute per task compared to one-shot inferences, guys. So developing on the answers, having a deep-form conversation with the AI, and making it think overall what it can already find in its database, right? When you try to just go through the thought process for AI. It's very simple for an AI to generate a generic answer based off of data that it has access to. But when you ask it to build a logical reasoning thought process on that data, especially for complex tasks, that's what requires a lot more compute power, obviously, right? Moving on further, the vast majority of our compute today is actually inference, said Jensen Huang. He said next generation AI algorithms could even need millions of times the current amount of computing capacity, which is absolutely insane. NVIDIA is not going anywhere. They're a hardware company for now, but if you know NVIDIA's competitive advantage, guys, is it the hardware? The hardware is nice, but it's the CUDA ecosystem. Think about that, okay, guys? Now, the company's gaming business, which includes GPUs for playing 3D games, reported $2.5 billion in sales versus the expectations of 3.04. There is a line of business miss, the only line of business miss for NVIDIA's entire earnings. The company announced new GPUs for consumers during the quarter that share the same Blackwell architecture as the company's AI chips. One of the company's growth categories is its business selling chips for cars and robots. They made $570 million in automotive sales. It's a small fraction of the revenue, but 103% rise on a year-over-year basis. And they also did $33.7 billion on share repurchases in the quarter. Is anything bad with this report, guys? Absolutely not. Take a look at the lines of business here. Data center, largely surpassing expectations on guidance as well. Gaming, there's your pain point. Professional visualization, that was up. Auto, that was up. And OEM and other was up as well. Only the gaming segment pulling a fraction of the company down overall. And when we take a look at the free cash flow, look at this free cash flow number by NVIDIA, guys. $60.7 billion for the trailing 12 months and $15.5 billion in the most recent quarter. That is absolutely fantastic free cash flow generation by the company overall. And when asked about DeepSeek and whether or not it would affect large-scale cloud providers or NVIDIA specifically itself, well, Jensen pretty much gave the same answer that we've heard from Google, that we've heard from Microsoft as well, and that we've heard from other large players. All it is going to do is increase the total addressable market, guys. That is all it's going to do is create more demand in the future. If people know they can run these LLMs for cheap, right, because of DeepSeek's advancements, well, a lot more players will start and try to run them. But still, when you're thinking about large cloud hosting services, which are not AI players, guys, there's two things here. There's the large language models for AI assistants, and that is big, of course. But number two, where are people going to store their data? They're going to store it with Amazon, with Microsoft, with Meta, And with Google as well, right? That part of the business is never going to go away. Those four companies have such a large lead and such a large command on the market. They will need these Blackwell chips in the future, and they will be able to get the new models of the chips that NVIDIA will produce in the future as well, because they have such a large cloud hosting service, guys. This predates AI overall as a whole. AI is a nice touch. AI is a nice new sales vertical for production and efficiency capacities. However, the data center business, guys, if I had to argue, right, a lot of that, a majority of that compute power is for the actual cloud data and cloud optimization services that these companies provide for everybody else. And for those services as well, what do they need? They will most likely be needing NVIDIA chips too. So all that to be said, guys, fantastic earnings from NVIDIA. Amazing margins right now, amazing free cash flow, $2 trillion in total addressable market data centers by 2028. DeepSeek is a total addressable market expansion opportunity, not a negative catalyst. 33.7 billion in buybacks. In terms of the valuation, after NVIDIA has been consolidating now for the better part of the last 6-7 months, where is the valuation? Well, before I show you the valuation here, guys, just keep in mind, look at how good this company is growing. The average analyst price target is 175 right now. Everybody almost has it either as a buy, strong buy, only 6 people as a hold. Look at this EPS ramp. It will not stop for the next 3 years. Look at this revenue ramp. Look at this revenue ramp. It will not stop for the next 3 years as well. All that being said, they're growing revenue and EPS at very attractive clips. On 2025 numbers, at 131, the current price, they're trading at a 29.5 forward PE. For NVIDIA, that's cheap, guys. That is actually very cheap for a company growing double-digit clips with such a high command of the entire market right now. This is very cheap. When you divide this by their EPS growth rate, that is a PEG ratio of a cool 1.28. This is the cheapest that NVIDIA has been in a very long time. Free cash flow yield at 1.9% is a little bit light. That's just because the size of their market cap is so high. In terms of the free cash flow they generate for their revenue because of these amazing net margins, this is actually very good overall. So the valuation of NVIDIA, in my opinion, does still remain a buy, and we are reacting nicely from our support zone, 130 down to about $125. I am a big fan, guys, as I've said many times on the channel, 130 down to about 115, this whole little pocket when looking at the weekly and even monthly timeframes right now, this whole pocket of accumulation that we've been kind of consolidating in and out of for the last 6-7 months, in my opinion, is a buying opportunity. If you have a longer time horizon for NVIDIA, I know the volatility has been quite high in the markets right now, but if you are buying shares for a longish term portfolio, I see no problem with adding a little bit of NVIDIA up here overall. But you guys know what's going on right now goes over and above NVIDIA, over and above big tech. It is economic concerns because of the new Trump policies. That may take time to iron out, but it definitely is not because NVIDIA itself is doing anything bad. And that is everything I had to say for the NVIDIA earnings report. Hopefully you guys enjoyed that one. Now, before we jump into Salesforce, let me just cover briefly Home Depot and Lowe's earnings. So let's go over Home Depot real quick. Those two had earnings kind of back to back, right? Tuesday before the open, Home Depot, and today we had Lowe's before the open. We'll be going over Home Depot specifically, right? Now, a little bit of the context for Home Depot and Lowe's. You guys know the drill. We've been talking about these now for the past few quarters. Why are Home Depot and Lowe's not performing very well? Well, because interest rates are very high, and when you have renovation projects that often are to the tune of $20,000, $30,000, $40,000, $50,000 plus, and you have high interest rates, especially if it goes with the Lowe's and Home Depot financing, 4, 5, 6, 7, 8%. That's very high. So a lot of consumers have been deferring and delaying their home renovation projects for the last year in anticipation of rates coming down. But we know the 10 and 20-year yields have been quite sticky. As a result, that lull in demand and those consumers keep on pushing back the timelines here. That is still front and center for these companies. And this earnings was no different at all. So let's take a look at the numbers right here. Decent numbers, beat on EPS by 3% and beat on revenue by 1.41, but it's the guidance. Wall Street wants to know, listen, when are your consumers going to actually start going out and spending money? And even the CEO, he says they're trying to right now, but we're not back in full swing, and we do not want to give that guidance. So here you go. Home Depot earnings beat the estimates as retailers breaks comparable sales losing streaks. Now, moving on further, Home Depot, even as Home Depot topped the expectations, even as elevated interest rates and housing prices dampened consumer demand for large remodels and pricier projects. For the full year ahead, they expect total sales to grow by 2.8%. Very, very, very low for Home Depot. If it was a different market right now with low interest rates, this company usually grows revenue at about 5, 6, 7, 8% per year. That is its industry standard in a normal market when the housing market is in balance. But right now, of course, we know the housing market is just not moving because home prices are high and interest rates are high as well. There's no replacement value for you to move and find another property, right? Rates are high and the prices of homes are high as well. The CFO said that housing is still frozen by mortgage rates, which I just said. Home Depot anticipates consumers will stop putting off projects as they gradually get used to higher interest rates rather than waiting for them to fall. They anticipate, they're not saying for sure, but they anticipate that people maybe have been pushing back renovations now for 1 year, 2 year, and maybe they just say, well, let me just go ahead and do it anyways, right? That is their anticipation. Will it actually come to fruition? We will see. They tell us their lives are moving on. Their families are growing. They're moving for a new job. They're upsizing their home. They want to upgrade their standard of living. Home improvement always persists. And so the question, I think, will be around the mindset of whether long-term rates have gotten to a new normal. Moving on further, customers spent more and visited Home Depot stores and website more in the quarter compared with the year ago period. Transaction rose to 400 million, up 8% from the year ago period. That is good. And the average ticket when checking out at Home Depot was up to $89.11, up from $88.87. So, not that much, about a 0.5% uptick, but still average ticket price was increasing overall. They didn't give a guidance whether or not that was because of higher prices at Home Depot or because of higher demand. However, considering the fact that the amount of transactions was up, you can argue that maybe it's a little bit of both. Moving on further, consumers still showed reluctance to splurge on bigger projects, such as redoing a kitchen or installing new flooring. McPhail said, the CFO, he said that this Home Depot opened 12 new stores in 2024, and they plan to open 13 new locations in the new year as well. So at least they are expanding ever so slightly, but it is an expansion. Some pro-heavy categories, such as roofing, drywall, and lumber, saw sales increases in the quarter because of Home Depot's push to serve contractors and other home pros better. This is very true, guys. Even though consumers themselves may not be looking to do major renovations on their single-family homes, you always have real estate investors and industrial and commercial projects, which will always need the service of those professional contractors. So as a result, Home Depot's business model, in my opinion, is a bit better than Lowe's just because they have more in terms of the pros, right? Now, Lowe's, if you take a look here, you'll see that only 25% of customers for Lowe's are professional contractors versus Home Depot, actually 50% of their client base is for contractors. So that is why I think that the Home Depot business model is slightly more resilient. Now, overall, if we compare the two, because we're only going to do Home Depot right now, if you want to compare the two, well, they're kind of sitting at the same position right now. Home Depot right now at about $390 is a 25.67 forward price to earnings. Not that bad, but still a little bit rich considering the uncertainty in the markets right now and not that predictable overall. However, it does give a very attractive free cash flow yield, and that is inclusive, of course, of a 2.34% dividend yield that the company gives on Home Depot, coming down into support right now, 385 down about 375. Home Depot, guys, is a very, very, very solid business. It's just, it ebbs and flows with the status of the economy. I would not say it's a toll booth company that regardless of what the economy does, this stock simply goes up. So for me, I'm not really looking to take a position in Home Depot right now, not until rates come down a little bit more and until we get some better guidance from the CEO, because they anticipate that consumers could be coming back and getting used to higher interest rates, but we do not have that clarity and that certainty, which means we do not have predictability. And in this market specifically right now, around the Trump tariffs, all the political things that are going on right now, we want to be looking for predictable companies that are used to making money in all markets. So for that reason, I'm not buying Home Depot, and I'm also not buying Lowe's. Lowe's, the forward price to earnings is a 19.96. Not that bad, better than Home Depot. Free cash flow yield is also better than Home Depot. Coming down into support, you could argue that on a technical basis, both of these charts look fine. They're just monthly uptrends looking for possible expansion, right? So if we want to take some swing trades on them, it's not the worst swing trade out there, but the economic headwinds that we're facing right now could mean that maybe the technicals can simply break down. So if I had to take a trade on one of the two, it probably will be Home Depot, but I mean, you got to trade this one with a stop loss, guys. The stop loss on Home Depot would go roughly around the 370 mark, and then you're targeting expansion to the 430, 440 level. So it's a nice little 2-to-1 risk to reward trade on Home Depot, and also for Lowe's as well. But putting this one in a long-term portfolio, they're just not predictable enough, and in my opinion, they just do not grow fast enough. I think there's better opportunities in the market, but the opportunity on those right now is a break below 227 for your stop loss, and then expansion to 280 for your take profit. Also about a 2-to-1 risk to reward trade. And that is everything for your Home Depot and Lowe's earnings. And now, let us dive into the Salesforce earnings, guys. So why is Salesforce down right now in the after hours by about, well, let me just pull it up on the chart right here since the after hours number is not on the screen. They're down almost 7% after hitting record highs late in December and also one more time late in the month of January. The company has now pulled back a ton, right? Now back to about 290. You're talking about a 20% pullback in Salesforce. After a 20% pullback in Salesforce, back into the all-time highs, back into a technical level of a breakout retest trade, aka a trend continuation setup. Is it a good buy or am I staying away? Well, let's have a look here, shall we? So in terms of earnings, they did beat on EPS, 6.53, but they missed on revenue. And that's one of my gripes with Salesforce is they're just not growing revenue as fast as I would like to see. Yes, they are the leader in terms of customer relationship management software. I mean, it is their ticker after all, CRM. However, guys, the revenue is just not growing fast enough. And I'm not too sure that I am sold on their marketing in terms of their AI agents being able to bring them that much tremendous value in terms of revenue expansion, because the guidance for next year from the company definitely did not show that overall. So let's move into this one, shall we? So moving into Salesforce, Salesforce misses on revenue and issues disappointing guidance. Curious. They're supposed to be ramping up this new AI division of their company. Mark Benioff is very bullish on that division. So why are they not able to guide for the same bullishness that the CEO speaks with when he addresses this issue? Let's move into the article, shall we? Revenue increased 7.6% from a year ago, which is decent, but a little bit light in my opinion. It is a mature company, but that's still a little bit light. Net income rose to 1.71 billion. That's decent. 17.1% net margins. Now, CRM has been doing a wonderful job at doing what Wall Street wanted. Wall Street wanted less acquisitions because CRM is known for just buying companies and adding them to their top and bottom lines. They wanted less share stock-based compensation, better cost management, and CRM has delivered on all three now for about 4 quarters in a row. Look at the net margins now. The last 5 quarters, 14 to 17% nowadays. But in the last few years, profit margins were always a concern for the company. Take a look what I mean. Here's your profit margin history, and you can see there was a net downstream here in gross margins through the last 10 years. Operating margins were never that high to begin with, and also net margins were somewhat inconsistent and somewhat unpredictable. But now that they've been focusing on cost efficiency and shareholder returns, you can see a clear-cut change over the last 2 years of time, which has accelerated in the last 5-6 quarters overall. Gross margins are back up. Operating margins are back up as well, as the company is more efficient and doing less share buybacks and more operationally efficient as well. Less sales, less marketing, less G&A. And moving on to the bottom line net margins, clear net increase here from the low single-digit amounts to what we are today at about 17.1 in the recent quarter. So at least that is good. They're delivering on what Wall Street wanted, which is more capital to the bottom line. Now let's move further. Salesforce said it had completed more than 3,000 paid deals involving Agentforce, their new AI agents, since October. Agentforce has gotten involved in 380,000 conversations through the website, with humans getting involved in only 2% of cases. That is actually very efficient. So you got to give praise where praise is due, and that is a very good efficiency ratio for their AI agents. A lot of other vendors are talking about their agent capabilities, but few are able to show that they've really got this running at scale. Now, this, in my opinion, the amount of queries for the percentage of cases that required human intervention, that is decent scale. I'll give them that. Agentforce will make a modest contribution to revenue in 2026 with a larger effect in the following year. So there's the reason. There is the reason. So they're still not fully up to scale yet. I'll give them the benefit of the doubt because they have a low resolution with human intervention case, but overall they are the market leader. So we will see whether or not how many Fortune 500 companies actually start adopting the Agentforce software. And when the reviews come in, we'll see. Because CRM, if anything, I mean, I've used it at my time in the bank. CRM, I mean, the software does what it's supposed to do, right? But I'll be quite frank with you, employees absolutely hate doing this, guys. They absolutely hate journaling their interactions with clients, journaling their interactions with back office employees as well. They absolutely hate it. It gives management very good metrics on consumer interactions, consumer experience, net promotion score ratios and whatnot. But I'll tell you, as an employee that used to use Salesforce myself, I absolutely hated taking the extra 5 minutes after an interaction with a client to type everything into Salesforce just because management wanted me to. Trust me, I did not want to do it proactively, but because I had to, right? Because the bank wanted me to, I would do it. And if you guys have used Salesforce before, you probably feel exactly the same, right? But it is what it is, right? As employees, who are we to criticize what the bank wants us to do? Like, that's your job. Like, you have to do it. Whether you like it or not, you kind of have to do it, right? So it is what it is. And will corporations continue spending on this because they want more transparency to see how their client interactions are going and various statistics with that? Yes. And they will continue to force you to use Salesforce. And to be quite frank with you, there's nothing else that you can really do about it. You know what I mean? It's not supposed to be a pleasurable experience. Who actually likes doing this? If the UI was better, if the interface was a little bit better, would you still like doing it? Probably not, right? So you got to take what you think about it with a grain of salt and understand that management will continue spending on this type of software to give it more transparency as to where to focus and how to improve on the business efficiency, right? Now, the U.S. Department of Government Efficiency, DOGE, is using Slack, one of CRM's products as well. We'll work closely with the government, said Mark Benioff. We'll do anything we can to help them succeed. Here's the pain point of the earnings report. The guidance. The company called for 253 to 255 in adjusted EPS for the first quarter, with 9.71 billion to 9.76 in revenue, both of which under estimates. The estimates for EPS was 261, so there's your miss, about a 4% miss there. And 9.9 billion was the estimate for first quarter. They came in light, 9.73 at the midpoint, right? So light on guidance for EPS, light on guidance for revenue, just not gonna get it done. That's why it's down 6%, 7% in the after hours. For 2026 overall, also miss on guidance. EPS 11.9 to 11.17, right? The guidance for that 11.18 at the top end. So missing on full year guidance. Revenue guidance 40.5 to 40.9, right? They also missed ever so slightly on that revenue guidance too. Unfortunately, not showing it here, but they missed double miss in terms of quarter and double miss in terms of the full year. So that is your numbers breakdown on CRM. Is it that terrible overall? No. I mean, they did have good capital returns to shareholders. They continue to do buybacks. They got about $10.5 billion remaining on buybacks for the quarter. And if you take a look here at most of their divisions, what you can see here is, although growth is slowing from 2024, this is 2024, this is fiscal year 2025, they run one calendar year, or one tax year ahead, rather. You can see that their businesses, all lines of business, are still growing, right? Slack total revenue down here about 11%. Overall subscription and support revenue, they're up, but they're just up less than they were in the past year. So once again, tough comparable numbers overall, slowing down a little bit. Their next sales vertical is going to be that agent force. And as we saw in this statement by the CFO, that will not see the true ramp until 2026 right there. So Salesforce this year could be a little bit of a sideways price action year for Salesforce overall. They really haven't moved since the month of November, and I would not be surprised if this consolidation can continue, just because we're not looking for any crazy beats on earnings or revenue over the course of the year. That is the guidance right now. And when you're trading right now at a forward price to earnings at 25.9 and a forward PEG ratio of 1.92, which is high for the growth that they're giving, right? It's just not a good deal right now. And the guidance just is not so fantastic that I absolutely feel the need to buy this company hand over fist right now, right? The technical setup is nice for a breakout, retest, and run trade. And you can possibly make a somewhat of an entry proposition at the 290. The stop loss would be somewhat quite wide, in my opinion, right? We don't really have a nice support level. What I would like to see right now after this drop, set a weekly uptrend. If we can set a new weekly uptrend, then you get a more defined level. The entry goes here, the stop loss goes below here, and then you target the all-time highs. But is this one going to go leaps and bounds higher this year, guys? I don't know. It might be a grind higher because the company is one of the companies that's loved by Wall Street right now. But the question is, do I see a hand over fist buying opportunity on the company? No. If I had some shares for a long-term portfolio that I acquired at a much better valuation in the 200 to 250 range, would I be selling here? No. The fundamentals are still quite decent. So what I'm saying is not good enough to start a position up here, at least not one with size. Could it be decent to buy some little dips here if you like the company? Sure. For a swing trade, sure as well, but just not one of my favorite plays, not at these prices at least, guys. If you really want to know when I would be highly interested in this one, I hate to say it, but if I'm going to be brutally honest, 260 to 240. I might nibble a little bit personally, right? And that's everything for your earnings recaps for today. A lot of earnings we recapped, a lot of the market headlines we had to recap as well in terms of market breadth. Now let's get into some of that juicy TA, shall we? So in terms of the TA, before we dive into the SPY, guys, what has been afflicting the SPY so far? Well, it's the tariff portion of the Trump policies. We know that, as I said on Monday as well, you need to view the policies in terms of the sum of all parts and not really one in isolation. And that's the problem here. The market's been focusing a lot on the tariff headlines, and this one definitely does not help. We got this one. I mean, the SPY and the QQQs were moving very nicely today. We got a very nice bounce early on in the morning today, and then it kind of eroded over the course of the afternoon. That's not the right candle. This is the actual bounce we're looking for from the fear lows, and then we got crushed midpoint through the day. Why? Well, because Trump was once again holding a conference, and they slapped 25% on the European Union. This should be no surprise. He's been talking about it for a while, that anybody and everybody was on the table. Now we get the headlines, right? So those are the headlines, guys. We got the Canada-Mexico headlines. We got the China headlines. We got the EU headlines. Who's left? Australia, right? Who's left? The rest of Asia? I mean, there's not that many people left, right? So we will continue moving through these tariff headlines. I mean, to be honest with you guys, and as I was telling my Discord members, this is what people voted for, right? He ran on tariffs. Nobody should be surprised if he's actually doing what he said he was going to do. The impacts, you can look at analysts' expectations. You know, a lot of analysts were saying that it might impact GDP by 0.3 to 0.4%. It might impact consumers by certain metrics. But the fact of the matter is, guys, those are just models. They're not exact sciences. In practice, right, the economics and the fallbacks of what's going to happen with these tariffs are largely unknown. But can we say one thing in the short and medium term? Yes, it is going to weigh on sentiment, and yes, it can weigh on inflation as well, especially for those imported products, right? Things that are made in America will obviously not have that problem, but things that are sourced from abroad will have that problem. And as consumers, as we've come to grow into a global economy right now, we like to buy a lot of things that are made abroad. That is the fact of the matter. So it will impact consumers in the short and medium term. But when we take a look at the sum of all parts for Trump right now, we cannot have a decisive conclusion as to whether all of this is going to be net negative or net positive. A lot of big executives and a lot of economists as well is when you look at the sum of all parts, the tariffs, the loosening of regulations for U.S. companies, allowing them to make more profit, the corporate tax cuts, the deportations, and the impact on the labor market, making more jobs for Americans, right? Possibly increasing the average wages and increasing productivity and efficiency. Those sum of all parts is very, very difficult, guys, to summarize a snap of a finger conclusion right now and say, yes, the economy is going to go down by X%, right? Very, very, very difficult. It will be an evolving landscape. This is very reminiscent of 2018. The markets right now are having a little bit of a temper tantrum, similar to what we had in 2018 when the tariffs started in the first place. This was Trump tariff round one, and overall top to bottom declines on the SPY was 18% in just a short 3.5 month time horizon. Now, it's not exactly the same as 2018. In 2018, we also had the Fed embarking on a slight interest rate hiking cycle, which was worst case scenario. Tariff uncertainty and hiking interest rates. Now we have the opposite. Now we have an interest rate cutting cycle, but the same level of tariffs, argue a little bit more tariffs. So we're seeing the same temper tantrum from the markets as we did back in 2018. Excessively difficult to predict, but if you want me to tell you what we have to do, guys, now's the time to play defense. And when I say play defense, it is not the time to YOLO call options, even on big tech at crush levels. In my opinion, still not the time, right? Broaden your horizons to toll booth companies. If they come down, companies like Costco, companies like Visa, companies like MasterCard, some of the very large banks, some of the value names that operate like toll booths as well, pullbacks on McDonald's, pullbacks on Coca-Cola, arguably, things like that. Focus your buys potentially in the near-term future on companies like that on large pullbacks. Because when you talk about stagflation, when you talk about a pullback in growth, the first thing Wall Street is going to go after is companies that are growing the fastest and that their share prices have benefited a tremendous amount in the last 2 years of rally. So on the channel, what we'll be doing moving forward in the next 2, 3, 4 weeks, I'll be putting a lot more emphasis on Healthcare names that have been drawn back recently. Companies like UNH, we could represent some decent buying opportunities, right? Companies like certain credit card companies, which will potentially be coming into pullback areas if the SPY and the QQQs continue to erode their gains. Focus more on the value side of the market right now. Keep nibbling on big tech, but a lot of the other swing trades, guys, may have more success if you target companies that are not so much affected by the narratives right now. Like TJX, just look for the trend continuation on very solid companies with very solid proven business models that have been resilient in the face of weaker than expected consumer spending, right? So keep that in mind. I'm not willing to call it a recession or a recessionary environment right yet, or a bear market just yet, but we still have to be a little bit cautious, put our foot on the brakes a little bit, and be more calculated with the opportunities that we're going for, right? Couple that with the fact that Alphabet, Google cuts employees in the cloud division. That led Google to go down 1.5% today. Again, how many employees did they cut? Fewer than 100 positions. So you can see, guys, any and every headline, guys, will get magnified by the markets right now just because the markets are so timid and they're throwing a tantrum. So that is an introduction to technical analysis. Keeping that in mind, the bears have full control of short-term momentum right now. Daily uptrend has been lost. At this point in time, any bounce going to be looking for a lower high, and depending on the size of the bounce, might just be looking for a lower high into either retest of the lows, into lower lows. That is if the bears just don't continuously flush the levels right now. We're not very close to daily oversold conditions at all. So if they do continuously flush the lows in one clean shot, that may give us the lower lows. But right now, we're breaking down below this major support level. 595 is the end of it. If you break down below, this becomes resistance. Lower high, lower low is definitely on the table for maybe a retest of the lower levels on SPY. 585 down to 580. That would be a top to bottom correction from the highs of roughly 5 to 6%. That is correction territory for the SPY. Even on the weekly, we are starting to lose the weekly uptrend and might just go back into the same range of consolidation. No new highs for the last 3 months. That may continue, and we may come down all the way into here. Max pain for this move, if it really comes into it, like 2018 style over the next, let's call it 5, 6, 7, 8 weeks. There'll be some up days, there'll be some down days, but if we progressively move into the lows, guys, anything is on the table. 565 down to about 550, in my opinion, is going to be short-term max pain. The SPY, on average, does have 7 to 10% corrections at least maybe once per year, especially in an uncertain environment. Matter of fact, you look in the last 2 years with a rally, we had a couple. We had 1.6% here in April 2024 when interest rates were front and center on everybody's minds and inflation reared its ugly head again. We had one here with the Japanese carry trade unwinding. We had a few back after Powell. That was another 5%er. So if this is going to be a big one, you can expect to see some of those 7, 8, 9% corrections on the SPY. That is for the next 7, 8, 9 weeks of time, guys. So keep that in mind. I'm not willing to call it just yet. I'm just giving you guys a max pain expectation so you are not surprised, and for you guys to pace your buys. Go for high quality companies, yes, but pace your buys. It is not the time to be loading up on call options right now in the market. It is time to be playing shares or writing puts under the market, being very careful and calculated with which companies you choose to do it on. Growth, risk on, maybe not the best niche of the market to be in right now. The Qs also losing all short-term momentum. The bears are in full control. Daily sweep of the uptrend right now. So now, even on any bounce, guys, what are we looking for with such a big engulfing move? You are looking for a lower high, and then we will see if the bulls can get a nice 50, 60% bounce. We can talk about a possible daily uptrend recapture. However, if the bounce is relatively weak, gets rejected at the EMAs right there, the retest of the lows or even lower is very possible as they embark on this brand new daily downtrend overall. You know, it takes a long time for the bulls to recapture those daily uptrends. We will see if they can actually get it done or not, right? You can see, right, when we get a nice rally up, right, need an engulfing move, and then it takes a while to reset the daily uptrend, right? Same thing here. If you get a nice bounce, it takes a while to reset the daily uptrend. So don't YOLO it right away. In terms of the weekly, we have not lost the weekly level all the way down to about 510. If you lose that, the weekly uptrend is officially lost at this point as well. Could be going for the max pain level. The max pain level for Qs, in my humble opinion, same thing as the SPY, guys. 50 EMA, which was tagged also on the Japanese carry trade day. It does not happen that often, but when it does, it's synonymous with large market uncertainty catalysts. So first stop is down there, 500 to 495, 7-8% correction on the Qs, which would be correction territory. And then you come into sell-off territory, 10% to about 12% to the downside, 480 to 470, which is why I say pace your buys. This entire region was a great buying opportunity, but if you ran out of buying power here, well, you would have felt a ton of pain going all the way into there, right? We do want to be buying these markets, especially into extreme fear reads, but pace your buys. I will not stress it enough. Moving on to the XLF right now. Let me just check the time. So the XLF right now down about 0.22%. The XLF also may be curling to the downside. It was a very nice daily uptrend continuation, rejection at the all-time highs, equal highs, lower lows, lower highs. And if we come into lower lows, you guys know the drill, guys. Daily downtrend will be underway on financials, looking for a weekly higher low at this point. Bull still safe. Anything above $47, still looking for that daily or weekly rather higher low for possible further trend continuation. Where could XLF come down to? Worst case scenario, possibly the 26 EMA, which right now is sitting exactly there, 48.50 to about 47. Look how many times the XLF has clipped into the 12 EMA, or the 26 EMA rather, in the last 2 years of rally. The banks are extended. A lot of things are extended. One of the things I'm looking at is maybe Bank of America. Bank of America coming down $42, $41, this zone right there. Not too bad of a buying opportunity, but it can go a bit lower, guys. Keep in mind, right? 42 to about 40 bucks. This pocket on Bank of America, not too bad. Credit cards, I will be looking for the monthly higher lows if the markets unravel. That is Visa and MasterCard right now, no buys, but these are all on the table. I will be patient. If the indexes continue falling and financials has a little bit of a dip, that is what I'm looking for. The weekly higher lows on some of my favorite financials companies in the market right now. So pay attention to that, guys. In my opinion, not the time just yet. Need to wait for a little bit more pain in financials to really free up the best levels. Moving into XLV right now. So XLV also down about 0.72. The bulls are trying to go for the daily uptrend switch. Engulfing move on the daily. Daily uptrend is set right now, looking for a daily higher low at this point in time for healthcare. Anything above 145, looking for a daily higher low for possible further trend continuation. On the weekly, it's still looking quite good. Big engulfing move on the weekly, right? Cup and handle, looking for the breakout out of resistance. The final area of resistance is 148.75. Not there yet, but also possible inverse head and shoulders. Healthcare has a ton of names that are not looking too bad at all the trade right now. TMO into 2 years of support, possibly looking for some upside continuation, maybe. Decent little trade opportunity there. UNH coming into 2 years of support after the Department of Justice headline brought this company down a lot. You guys have seen me buy the DOJ headlines on Apple about a year ago, on Visa about 6 months ago, on Google roughly about 4 months ago as well. Usually the DOJ gives us phenomenal buying opportunities, and UNH, this could be a very decent candidate for a little bit of a swing trade. Stop loss goes below 438, and you're looking to target the highs here of about 534. Decent R&R trade in my opinion, but just don't go too heavy overall, guys. These are great swing trade opportunities, but you got to keep it a little bit light in this market environment, right? Because you know that if the markets are picky, they can go stop loss hunting, and it would not be surprising if they did do it again on UNH despite being in big support. But I like this one, and I probably will be opening one of these myself. Moving on to semiconductors right now. So semiconductors up 2.34% on the day as we had some nice leading catalysts into NVIDIA earnings, right? The tech semiconductors not too bad, and NVIDIA after earnings is roughly flat. We'll see how it comes into actual volume into tomorrow, but the earnings report was great. I would not be surprised if we get analyst price targets either at hold at their current price targets or maybe even raises of price targets, and that could give a nice little lift to semiconductors overall. That being said, daily uptrend on SMH has now been lost overall, guys. The higher lows were right there, and now we lost it after the most recent few days of trading. We will see if the bulls can start charging back into resistance, but I mean, what are we doing here, guys? It is still trapped in the same levels. 260 to 250 is resistance, and below support, 230 down about 220, until I see a clear weekly uptrend with a weekly close above 260. I cannot say the semiconductor industry as a whole is ready for that next leg of rally expansion, that next leg of monthly expansion as well. It is just consolidation at the highs for roughly the last how long now, guys, in these levels? Since May. It's been a very, very, very long time. And until we get more clarity on policy, more clarity on restrictions, export restrictions towards China, XYZ factors, guys, you're going to need a green light scenario for these markets to run. As of right now, I'll still do the same thing. I'll keep playing the market leaders, NVIDIA, TSM, and Broadcom, pretty much short puts under the market into support levels. IWM Russell, well, I've been telling you guys that this one was a very tricky trade, and it remains a very tricky trade. Got rejected at resistance earlier this week, and last week, 231 down about 226, and now we're right back into support, 216 down about 208. Do I want to play this one, guys? No, not really. Not the market for growth environment right now. Overall, interest rates still remain a little bit too high for me. That being said, the bulls, not quite daily oversold just yet. I don't know if you can see that. Maybe my big head is in the way. Below the 200-day moving average as well. Daily downtrend coming in hot. So what the bulls need to do, need to get a nice engulfing bounce, reset the daily uptrend, and attack support. This one is just trapped between two levels right now, guys. I know I said I would play it if it came down here in isolation. But with the way the market's going right now, with the narrative that the market is currently embarking on right now, that growth is going to taper off, inflation is going to be sticky, interest rates are going to remain high, and just the dislike for the Trump policies overall, Trump was supposed to bring in this narrative of risk on and growth for the bull market, right? We are just not seeing it. So unfortunately, IWM, I'm just not interested right now. I'll play the highest quality growth names in the market, big tech, and I'll also play value names. But am I going to go for unprofitable small caps? No, those need a green light market where everything is running and then they run last. Until we see big tech come back and large predictable growth names come back, do you guys think small caps are going to run? No. So you may as well just stay sidelined and not trade this one. It's going to be very choppy for a while. Dow Jones as well. Dow Jones down. Breaking through the daily downtrend is clear as day right now. Daily downtrend possibly looking for lower lows into support right now, 43,300. 40,000. And if you crush that one, we are going even lower. We're going to drop one level, 42,005 down to about 42K, which is around the 200 daily moving average. The Dow has not tested the 200-day EMA in a very, very long time. We came somewhat close to it in the Japanese carry trade event, still not close to it right now. And that, top to bottom, if we come down there for max pain, that would be almost a correction territory on the Dow Jones, down about 6 to 7% in the 200-day moving average. As of right now, though, the bulls on the weekly timeframes are not looking too bad. Still looking for a weekly higher low for possible further trend continuation. But if you lose this level, 43.3 down to about 43,000, the 26 EMA, which the bulls have done a great job holding for the last 2 years worth of rally, if you lose that in a meaningful fashion, it's going to take so long to get this weekly uptrend back, guys. You guys see, when you lose a weekly uptrend, you guys see how long it takes to reset the price action? A very long time. So this one could still be a little bit choppy in the future. And that's just the fact of the matter for the Dow Jones. But all in all, not looking too bad, all things considered, right? In terms of yields, we'll take a brief look at yields. Yields are still coming down, but not for the same reasons. Yields are not coming down because inflation is going away. Now, yields are coming down because people are actually buying bonds as part of a safe haven trade. Take a look at the last 2 weeks of trade on the TLT. You can see a clear shift over to the risk-off assets as investors seek to buy protection overall and seek to buy just assets, right, that are kind of immune to any policy fears right now. Take a look at safe haven demand, difference in the 20-day stock and bond returns. Lowest point that we've had since when? The Japanese carry trade unwinding. Extreme fear, meaning there's a high demand for safe haven assets, and TLT is one of those. So can we see a progression of the rally in bonds overall, which will bring down yields as a byproduct because they're inversely correlated? Yes, but this is not because Wall Street is tapering back their inflation expectations. This is because people are actually buying bonds because they want the safety trade. Weekly uptrend now decently in motion for the TLTs, and the monthly chart as well, showing a nice little recapture in terms of monthly momentum. So all in all, could this be a very good trade as a hedge for the markets as yields continue moving to the downsides as investors seek protection? Absolutely. TLT arguably is maybe one of the best hedge trades right now. You can talk about SPY puts, you can talk about SQQQ calls, but TLT shares or long dated call options, or if you want to go for the juicy one, something like a TMF with some shares, not the worst idea in the world right now, even if they have run a lot, guys. Any pullback looking for a daily higher low for possible further trend continuation on the TLT. So could be a decent little trade right there. And I already have some, but I may even be adding a little bit more as a hedge to the overall market as we move into the volatility. Moving into Bitcoin right now. So the risk on assets keep getting destroyed one after one. We saw pullbacks on Palantir, pullbacks on HIMS, pullbacks on SoundHound, pullbacks on all the quantum computing names, pullbacks on the rocket stocks, pullbacks on the energy plays, the electricity plays to power the data centers. Every single growth play in the market right now is getting hit, and Bitcoin is just the last example of one of those, breaking a very big level right now. The clearest time frame is, of course, the weekly downtrend. Unfortunately, this is the first weekly downtrend we've had since March into that June session right there. Weekly downtrend clear as day, breaking support clear as day, 92,000 down to about 88, below the 200-day moving average. Unfortunately, guys, any move higher, looking for a lower high into now resistance, possibly looking for the absolute flush on Bitcoin. Is it over? Not willing to call it just yet, but are we into deep weekly consolidation and monthly consolidation as well? Yes, you should be used to this by now. Bitcoin has monthly consolidation all the time. Could we be looking to maybe go attack the 12 EMA over the next 5, 6, 7, 8 weeks as we move through this uncertainty? Absolutely, and that stands at about 75,000, which is a retest of our previous breakout area overall. So the charts short term look quite nasty, and they are quite nasty, and I'm not buying just yet, guys. You know I've been swing trading Bitcoin a lot here. I did not get trapped on this one. I told you guys, be careful. When it was barcoding here, I said, be careful. When the volatility comes in and it breaks either direction, it's going to come in hot. Do not get trapped here playing MSTR, playing BITX on low volatility, because when they bring in the volatility, either to the upside or to the downside, it's going to be a very big move. And now you see why. Huge move to the downside. Some of you may be trapped, but guys, just remember who's in control. The bears. Looking maybe for a lower high into lower low. If the bulls want to save this, you need it saved. Engulfing move back above support and then look to reset the daily uptrend. But until we see that, the bears remain in full short-term control. They remain in weekly short-term downside control as well. And we remain in monthly consolidation on Bitcoin. Next target for me, if I'm looking to buy some Bitcoin, would have to be 75,000. So if I'm looking to write short puts under the market, I'll be looking for BITX, right? BITX way lower than right now, talking about $30. I know it's low, but this is 2 times leverage, guys. Do not get trapped. I'll be using short puts, which are your best friend. And that is it for Bitcoin. If you want to know about the rest of crypto, well, obviously the rest of crypto is not going to do anything without Bitcoin, right? So continue to see slight declines in Bitcoin overall. Look at the Bitcoin dominance chart, guys. Bitcoin dominance still at highs. The altcoins, ETH, Solana, everything will not rally if Bitcoin is continuously losing levels. So keep that in mind. I would play Bitcoin first. And only when Bitcoin starts recovering, we can rotate into the altcoins. And that is everything for crypto. Now let's move into some of the juicy stuff, shall we? So now we're going to move into our big tech names, and I'll cover these a little bit quickly, just because the video is getting a little bit long right now, and I do have to cover my trades. So moving into Apple right now, Apple's still a nice daily uptrend, but pulling back now after about 7, 8, 9, 15,000 days of rally in a row, pulling back into support. 237 down to about 230 is going to be the support range for the stock. So the bull's not looking too bad. It is still a attempt at a weekly uptrend recapture by the bulls, but they need to play defense in this region. We will see how it goes. Although Apple is known to be a bellwether for the market overall, the one reason that Apple was doing better than the rest of big tech guys is because they're not the ones spending $100 billion. Well, actually, that's not true anymore. They said they'd commit about $100 billion to the $500 billion plan for the U.S. to expand AI. But they are not the ones plowing billions and billions and billions of dollars into data centers just yet. So that's why they did not get hit as much as the other companies like Amazon, Google, Microsoft, and Meta, right? They were able to keep it up, but now even Apple coming down almost 3% today. So we'll see how it reacts. Apple, still not my favorite one for a swing trade, to be honest with you, because valuation remains a concern. Their flagship product, the iPhone, is still not ramping to the capacity that you would want to see on that one. And let's be quite frank, Apple Intelligence, although it has a few nice quirks and features, is it groundbreaking? Is it a game changer for the company? No, but I'd like to see them expand on their offerings over that. But so far, a lot of other players have caught up right now, guys. I mean, I was even looking at some the Android-powered phones here in Thailand. They have a lot of brands here that are either from China or otherwise sourced. Lesser-known brands, of course, right? But I mean, the new phones coming out of China, guys, like I've seen them now for the first time in person because they don't have them in Canada and the US, right? When you go looking at the stores, I've seen them now when I went to my trip in Japan. I've seen them now when I went to my trip in Thailand here as well, because I like to go out and on the stores and compare. The new phones from Huawei and stuff like that, I mean, they're very nice, guys. They're very nice. They're very fast. The specs are amazing. Apple's benefit has always been the ecosystem. Let's not get it twisted, right? They don't really, you can argue that whether or not they have the best products in terms of specs, right? Probably not, but it's the ecosystem, right? And the ecosystem only takes you so far when people are looking for bullish catalysts for big refresh cycles. And so far, Apple doesn't have that. So at a 3.17 peg, not my favorite company in the world right now. Looking at AMD. So AMD up about 0.75% today overall, but it's not looking the best, right? AMD bulls, nowhere to be seen right now. Continuously a stair-step pattern to the downside, guys. Just, stairs up, elevator down every single time on AMD, right? So daily downtrend remains, weekly downtrend remains, monthly downtrend remains, and we're coming into the lower end of support, which ends at about $97. That being said, focus on the valuation. At about 108, 105, the valuation right now is trading right around almost a 0.5 peg, which is extremely cheap in relation to their growth. We will see if NVIDIA earnings are able to carry some of the semiconductor names higher over the next maybe week or two. do. Maybe we do find a basing of support, but the bull's got a lot of work to do. Let's not get it twisted, right? Need to see a nice engulfing move, reset of the daily option. Only then okay, we can start looking for a weekly engulfing move to reset the weekly uptrend, because right now we have no trends at all. So if you're interested in this company, the way you should be doing it is just nibbling. Small little nibbles. We have no trends whatsoever, so we cannot commit size. If I see a daily option recapture, perfect. I get in here, stop loss goes below there. I can get into a trade with size, and then we target the 130 expansion level for some take profits, right? But buying falling knives, there's only one way you can buy falling knives. And for the most part, it is very small and very slowly overall into the support region. Moving into Amazon right now. Amazon up about 0.73%, but we know Amazon has just gotten crushed since earnings, right? Clear, massive downswing, massive daily downtrend into almost daily oversold conditions by the bears right now. But that being said, all we're looking for right now, because of the size of this move, is we're looking for a lower high for possible lower low. Now, the bounce is okay so far, but if you want to look at the actual size of the bounce to consider, the size of the bounce right now is about a 50% bounce. Not the worst bounce. The bulls do have some space to reset the daily uptrend, but I would like to see a little bit more in terms of bounce size up to the 618 and really get back cleanly above this box of support, which is 215 down about 208. Get me cleanly above that and then reset the daily option, and then we can talk about some expansion. But as of right now, short-term bears are in control. I think the valuation down here at 215 at a 1.69 peg is quite decent. That being said, we have lost the weekly option at this point for the first time in quite a while at this point, right? We're looking eventually for the bulls to recapture this, but slowly, weekly options take some time to get back. When you know the weekly option is lost, it is synonymous with what? Monthly consolidation, right? It is a beautiful monthly uptrend, but eventually the bulls need to set those monthly higher lows. And if push comes to shove, if we really start getting some crushes, more crushes, because now we're down a lot, if we start getting max crush, guys, maximum pain for Amazon is probably 200 down about 190, which is this range right there, 12 EMA, the breakout area from here, previous resistance, which will now be current support. The 12 EMA is there as well. Looking for the monthly higher low for further trend continuation. So pace the buys. Can we buy a little bit here because we're not sure if it comes down there? Yes, but always keep your eyes open that you have to plan for a DCA, and the DCA level on the monthly at least is down here. So pace the buys. I'm buying Amazon now, but I'd be lying to you if I said that it couldn't go down all the way to about 200. That would be a top to bottom decline on Amazon of roughly 20%. In Amazon's history, in a bull market, has it always been a good proposition to be buying Amazon 20% down? We'll just have a look, right? Anytime they pull back 15 to 20%, it has been a great buying opportunity for this company. You can go back all throughout the years. 20% pullbacks from highs on Amazon are decent buying opportunities. So when it starts being 10, 12%, you know you need to start nibbling. And then when it goes to 15, 20%, then you need to know that the buying should start accelerating on your part if you want to hold this one as part of a longer term swing trade or a long-term portfolio. Moving on to Google right now. Give me a brief second. Haven't done that in a while. You guys thought I didn't have a coffee for this video? You're mistaken. Moving on to Google right now. So Google, this headline right here, I erased it right now. 100 employees being cut from the cloud division. Google has like 90,000 employees, 100,000 employees. They cut 100 people and the stock was down 1.5% today. It actually started the day off not too bad, but then that headline came out. Trump tariffs came out and kind of undid everything, right? They also have a lawsuit from Europe, I believe, which they have to settle for about $100 million, which is literally like an hour of revenue for Google. But anyways, it was once again another negative day for Google in terms of headlines overall. Google now, guys, yes, we're in a daily downtrend. It's as clear as day right now. Daily downtrend into support into the 200-day EMA, which is 175. Guys, the forward price to earnings at 175 right now is like a 19. A 19 forward price to earnings for Google. The PEG ratio right now is a 1.3, 1.35. That's dirt cheap for Google considering their cloud growth, their net margins, and all the other lines of businesses. YouTube just had a billion listeners in terms of podcasts as well. YouTube growth, Google's search and advertising business as well are doing very, very strong. Some people say it will be disrupted by AI. AI can only do so much, guys. I know you guys think that a lot of people are using ChatGPT and other chatbots, but when you do a Google search, Google Gemini also shows you the results, right? Can you use ChatGPT to plan a vacation, to shop for hotels and stuff like that? Not yet, right? Can you use ChatGPT to look at maps for directions and stuff like that? Can you look at ChatGPT for restaurants with pictures and peer reviews? No, you know what I mean? So Google's business is not, it's not going to die to chatbots, guys. Not even close just yet, right? In terms of in-depth, detailed answers, sure. But if I'm looking for a direct link to something, you still have to use Google, right? Like ChatGPT is not going to give you a direct link to something. I mean, it can sometimes, but when you're looking for something specific, or just to go out to eat, to travel, for directions, for anything that requires pictures or every different inputs, that is true. When you're looking for a video answer, you go to YouTube. So is Google's search business really at jeopardy of being lost to AI? Nowhere close, guys. Nowhere close. Just headline, short-term headline risk, right? Now, the gap fill has been filled right now from the month of December. Full gap fill right now into support, which right now is currently sitting about 178 down to about 170 short-term support. And the weekly uptrend has been lost as well. We can see that clean sweep to the downside. Daily is daily oversold conditions. So couple that with 200 EMA, very low valuation, into support, daily oversold conditions. I have to be buying Google here, guys. I have to be buying. My future self will thank me indeed. In terms of the monthly is also in a monthly uptrend, looking for a monthly higher low, coming into the 12-month EMA, which the bulls have held for the last 2 years worth of rallies as well. So this monthly candle looks scary, but we need to be buying in the face of fear. But pace your buys, nibble, 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 especially at these crazy low valuations. Decent, and I will continue playing this one. Call debit spreads are your best friend as well. With a bit of time, May, June, call debit spreads, not that bad of an idea. And just shares, just add to the long-term portfolio if you can, if you like this company. I'm not trying to convince you to buy Google, but if you like Google, now is not a bad opportunity as well. Meta on the day up about 2.5%. Meta actually one of the best performance of all big tech right now. Let me have a look at the time, guys. I mean, I'm spending more time on this video because I haven't seen you guys. I think there's a lot to say, right? I think you guys might appreciate that I spend more time. But now we'll get into the ones that take a little bit less time to speak of, right? So Meta was a very nice daily uptrend. We've given back a lot of that move, guys. It was such a very large move to the downside. I would not be surprised if the resulting bounce is just looking for a lower high. Then it's up to the bulls to reset. But if you want my opinion, if the market turmoil continues, we might be heading for a daily downtrend and a retest down there. The weekly is also not looking too bad. Weekly still remains in a weekly uptrend, looking for a weekly higher low, anything above 580, looking for that weekly higher low for possible further upside trend continuation. Or are we just going to get stuck in something like this where Meta pulls back a lot and goes sideways for a while? That's very possible as well. It's had a tremendous rally so far. The valuation is somewhat quite elevated at a 2.3 peg right now. One of the highest valuations in all of big tech. They're growing well. The profits are good. The advertising business is flying. But many people say this one's going to $1,000. Not this year, in my opinion, guys. Can we come back into the 700s? Yes. Is there a swing trade opportunity here? Debatable. I'd be more patient and wait for 630 or 620 myself, but fantastic company, right? Moving on to Microsoft. Well, Microsoft under 400 right now, 0.46% to the upside, but it's just not enough, right? The Microsoft bulls are just nowhere to be seen as well, right? Daily downtrend overall, the weekly also, weekly downtrend on Microsoft. And now in our last line of defense, the whole 400 and 408, roughly down to about 390 to the lower end of support right there. Below all the moving averages, Microsoft very rarely trades, unless it's in a bear market, below its 50 EMA. Microsoft very rarely trades below its 200 daily moving average, unless it's in a bear market overall. Now we have a pullback from the highs to the lows on Microsoft of about 15%. If you go back in Microsoft's history, it has always been a very good proposition to buy Microsoft when it is down 15%. We are also into the 12 EMA on the monthly, into large support. I continue to be a buyer of Microsoft at these levels in the support zone. I like the company, guys. It's one of the most solid companies in the entire market. Fair value for Microsoft, in my opinion, right now is about 430, 440. But if you take a look at the analyst price target, that's fair value, right? If we're looking for expansion, well, then the price targets all make sense at about the $500 mark. And that is my price target on Microsoft as well for the next roughly 6 to 12 months is closer to 500. But now it's just being caught up in the narrative. With the rest of the big tech sell-off. Unfortunate, I know, but once again, a decent buying opportunity if you have a long enough time horizon. Moving on to Netflix right now, 1.31% to the upside. Not too bad of a showing for Netflix overall, but we have lost a daily uptrend that is clear as day, similar to Meta. Any bounce from here, even though we are into a level of support right now, any bounce could just be looking for a lower high and maybe retest of the lows right there. On the weekly, you can see that even better, right? Is a weekly uptrend, yes, but we're still into weekly consolidation. Can we retest these lower ends of the 12 EMA, 940 to 900? Absolutely we can, and we would still be looking for a higher low. Anything above 823, looking for a higher low. Netflix had fantastic earnings, but in this market environment, guys, nothing will be spared, unfortunately, right? Netflix trades somewhat elevated at a 1.83 peg, not the worst valuation. Meta is worse, but still, is it super cheap? No. And when things are not super cheap and growth is a concern and the stock is trading well extended from its 12 EMA, we know that Netflix can pull back towards its EMA for monthly consolidation. So after 6-7 months of pure upside, can we maybe see a market which brings Netflix down if the rest of the market pulls back? Yes, which is why I'm very cautious on any buys that I make on Netflix up here, especially shorter term swing trades. You may end up with a nastier than expected surprise if we do pull back into the 800s, which would be a buying opportunity, but be slow. Be patient and let the market come to you. Moving on to NVIDIA right now. Well, we just did NVIDIA, but NVIDIA after their earnings, right? They're basically flat to where they were at the day, how the day closed, right? So that being said, the daily bulls, well, they did lose the daily uptrend. They flushed. Now the bulls need to get it back. The one thing that's good is we're reacting from support 132 to about 125. I remain positive on NVIDIA, and if we do get a little bit more downside of weekly consolidation, I'll be a big fan of, once again, writing short puts. 115 down to 105, the lower end of support. I already told you guys the valuation is beautiful at 131. So imagine if it comes down another 10%, the valuation will be like a 1.15 peg. That would be absolutely amazing. So the best way to play NVIDIA, in my opinion, is yes, we can nibble some long-term shares here. Yes, we can make some slight call debit spread plays. I wouldn't be going full YOLO for call expansion right here. Not at all. Not in this market environment, guys. Excuse me, got something in my eye. Can we place short puts under the market and accumulate shares at better levels? Yes, absolutely. And that's going to be the thing that I'm going to favor moving forward. But right now, still just sideways consolidation for NVIDIA as it grows into the new valuation right now, which is very fair. Moving on to Tesla. I mean, I can't say I told you so, guys, but I did tell you so, right? I told you be very nervous on the break of this $400 level. It's not going to be pretty, and pretty it was not. Daily downturn is clear as day right now. Daily oversold conditions, 26 on the RSI, eclipsing the 200-day moving average as well. A lot of stocks now below their 200-day EMA. Weekly is just downswing, massive downswing right now. Momentum is super hot, guys. So when momentum is super hot to the downside, I mean, I've told you once, I'll tell you a million times, right? Tesla's valuation right now, and I'm telling you guys as a Tesla shareholder, Tesla's valuation is encompassing what they're possibly going to do in 2028, 2029, and 2030. That is too far out to run a DCF model. There's too much uncertainty. If you're banking on that, guys, for short-term price appreciation, it's just not going to work. That's not the way Wall Street works. Sometimes it works when the narrative and the sentiment is favorable. They can go on the moonshot. Now you've seen the complete reversal, right? All of this moonshot. People were saying, well, Trump and Elon, best friends right now. The stock's going to absolutely moon. Trump's going to deregulate a lot of industries for Elon, which he will. But still, the sentiment right now is that Trump and Elon equal bad. Go on Twitter, go on the media. That is the sentiment that they're drilling into people's minds. Trump and Elon equal bad, right? Very simple. So moving on, doesn't mean you have to agree with it, right? But I'm just saying that this is what's affecting the stock right now. Now, if we want to be buyers of this stock, if you ask me my honest opinion, if I were writing short puts, I would not be writing for them for a dime above 250 at this point. I thought it was going to come to this, and it actually has come to this. So I have not played Tesla, guys, in the last 5, 6, 7, 8, 9, 10 weeks. I have not played Tesla, guys, since pretty much October. And I will not play Tesla and for a dime above 250. I'm not saying it's going to go there, but if I'm looking to write short puts on Tesla or TSLA, which is a lot cheaper, you got to go for the absolute crush zone levels, guys. Got to go for the absolute crush zone levels, because the valuation, even if I cut this one in half at 407, if we go back to 200, it's still a 3 peg. It's still a 3 peg at 200. It's just too high. It's just too high. And unfortunately, we've seen over the last month, Tesla's EV sales in Europe, in Asia, and even in North America are starting to slide as people tie more and more Elon Musk's actions with the government into his businesses, and Tesla is suffering because a result of that. So short puts all the way down there, but I'm not playing this one. I'm not playing call options on this one. I'm not even buying shares, guys. So fact of the matter, I will just sit on the sidelines and wait for the damage to be done and wait to establish a more normalized area of support, which I do think is, coming into the 250, 240 levels. So we'll see if it gets there. But a bounce could be coming sooner than later, but a bounce would just be looking for a lower high into possibly equal lows or lower lows. It's all about the size of the bounce to reset. So watch out for it. Now, moving on to Palantir. Palantir as well, right? They keep killing these growth stocks one after the other, and Palantir is just the recent victim of this just taper back in growth, right? Daily uptrend was lost. Now a massive, massive, massive swing to the downside. Would not be surprised as well. Any bounce higher, guys, probably looking for a lower high. Then that's up to the bulls to recapture, right? If the bounce size is too weak, what do you think is going to happen? Going to roll over for lower lows, go back to the support area at 83 down to about $80, which is the highs previously. Resistance now are going to be new support lows. You can see that even better on this chart, reacting from the 12 EMA, but this is a very big move to the downside, guys. I would not be surprised if this, especially in this market, is the beginning maybe of some extended consolidation on Palantir. The valuation is way, way, way too high. So if you guys are sitting here expecting a rally to 150, is it possible? Sure, anything's possible. Is it probable right now with the way the market is moving? Debatable. Very, very, very debatable. My favorite way of playing this one, you ask? Well, short puts to the downside. I'll be looking for volatile days of sell-off pressure. And with that sell-off pressure, I'll be looking to lock in very cheaper, much cheaper levels on Palantir, thinking $70 down to $60 short puts. I'm not saying it's going to get there, but that's the beauty of writing puts, guys, is when you write puts, when it has a big red day, I'm willing to buy the shares down there. If it doesn't get there, I don't care. I'm putting premium in my pocket, right? And if it does get there, that's where I actually want to buy the stock. I'm not trying to buy the stock up here, trust me, right? And that's me telling you as a Palantir shareholder. Now, lastly, moving on to SOFI, let me check the time. So SOFI, 3.95% to the upside. Not looking the worst, not looking the best, though. Protecting the lows around $14, that being said. So everything considered, guys. Support level down here, $16 to $14. Still not losing it, but we know that the market's been somewhat tumultuous recently with SOFI. Unfortunately, weekly downtrend, but in the grand scheme of things, just sideways, very wide range of consolidation, right? Looking for the monthly higher lows for possible further trend continuation. And I keep saying, buy, but buy slowly, right? Nibble a little bit at 14 with some short puts, some at 13, some at 12, because on the monthly, you guys know the drill. We are extended from the 12 EMA. Can we see some further monthly consolidation into the 12 as the markets reprice to the downside and take a lot out of these growth stocks? Yes. We'd be looking for a higher low for expansion. I still do think SOFI can clip into the $18, $20 range for 2025, but maybe not just right away. So I'm a fan of buying, but am I loading the boat at one price and just crossing my fingers? No. Progressively buying and using short puts for that process as well. I mean, call options, possibly, but keep them very small. I think you know what I'm saying right now, guys, is it's not the market for call options. We're not seeing the ridiculous, phenomenal rallies that we saw in November, early December, and even at one stage in the month of January. We're not seeing them, guys. So keep that in mind, right? Your call options, you got to put a ton of time on them. It's either leaps, like 2027 leaps for me, or call debit spreads and keep the trades small and just go for swing trades level to level. 14 up to 16, take the profit. If you have 3-4 contracts, close 3 and leave a runner, something like that. But I'm not in the business of letting things ride too far in this market overall. So that is my take on the market. We don't have time to go through any stocks. We did earnings. We did a full recap of what's been happening. And now we got to do the portfolio. And unfortunately, this will be my last video this week. Next week, I'll be doing 2 videos, and then I'll be back home in Canada. So we will resume our 5 daily videos, or 5 weekly videos, 1 per day. So that being said, let us look into my portfolio for some of the positions that I have open right now. And that'll be the end of today's video. Okay, taking a look at the portfolio, guys. You know that I'm always very transparent with my wins, transparent with the losses as well. And as you can see, we have round tripped almost all the gains in 2025 so far. We were up at one point almost 17%. We've round tripped a few of the call options that we've had, have given back a lot of the gains, and some of the wheel trade positions are now somewhat underwater. But the focus is on high quality companies at good prices, and I'm very happy with all my prices. The indexes are negative right now, and I know it looks like a big move, but keep in mind, guys, I'm running 2-to-1 margin on this portfolio. So although we are down on value in terms of about $5,000 in the last roughly week and a half of trading, it's $5,000 on 100K exposure, right? So we're only down 5%. So although you can see a 10% drop here, it's magnified by the leverage, of course, right? But when I take you through my positions, you will see that my positions, in my opinion at least, are very solid and also somewhat defensive and all at great levels. I am not trapped at the highs on anything. It's just that the things that I have pushed a little bit lower. And some of the gains, a lot of this erosion here are from some call options that boosted the account when times were good, but now tapering back a little bit. And I'll show you these positions right now, right? So number 1, I added to the AMD call options yesterday before NVIDIA earnings. This is my last stance on AMD. December 19th, 2025, 140 calls, added one at about $7.40. Average price now $14.63. We will see what happens. I was down 70% on my first call option on this, bought it at 125. Now in the lower 100s, I'll do one more contract and we're just going to let it ride. See what happens. The valuation is good. This is my attempt, not committing more capital on this at all. $3,000. We'll see what happens. AMZU, we got assigned 100 shares of Amazon on the 2x leverage model. 2x ETF leverage of this. This is synonymous with buying Amazon in or around almost the current prices. And also keep in mind that a lot of these, I have also, let me just move on to this overall. I'll show you guys these assignments, right? Assignment tracker, AMZU. I have covered calls on this one. My average cost for AMZU right now is 40.16. So even though we are close, we're below that right now, even though we're at an unrealized P&L loss, I have covered calls, very juicy covered calls as well. I will reduce my cost basis and average into this one if Amazon goes to 200. I am buying the dip on my favorite companies. ARKG, we had about $1,000 almost running P&L on these ones. ARKG has pulled back. There is $1,000 of that $5,000 loss pulling back from here. All in all, we're just back to the same level. So we just round tripped some gains, but are we at a massive loss? No, we're back to break even, and I have 2 years of time on these contracts for the most part. Moving on, Elf Beauty, still assigned on Elf Beauty, 71, that's not changed. Massive covered calls on this one. My break even is like $65 for Elf Beauty. Are we that much underwater? No, not at all. We'll see what happens. Moving on to ETHU, 200 shares, $1,000 position on ETH. Yes, we're down about $300. Is it the end of the world? No, because I have some decent covered calls as well. My break even on ETHU right now is roughly about, let's call it, $455. So we are underwater by about, what, $200, something like that with the covered calls. Not that bad, guys. A very tiny, tiny, tiny position on Ethereum. Moving on further, EVVTY, this one is still struggling, but coming back a little bit. FICO, this one is doing well now. We bought the dip on this one, almost up $80 on that one share. Google, I had a call debit spread leap. I since closed that call debit spread leap. I pocketed about $650, right? Closing the short leg of that call. And now we're keeping the long leg of the call overall, as you can see right there. Now we also have some debit spreads. I don't know why it's not showing the debit spreads for what they are. Let me just try to redo it real quick. Is it going to show them properly? No. This anyways is a debit spread, paid about $2.15. If you guys want to see the trade alert, it is right here. So here's your $2.15 entry for a call debit spread for June. I'm buying the dip, but buying the dip very, very, very slowly, right? Very, very, very slowly overall. Then moving on further, I have 100 shares of GOOG that I got assigned at 185 with about a $2 credit. And now we have some covered calls as well. My break even on GOOG overall, if you want to see it right here, is, if I can find it, I think it's in the weekly wheel position. Well, I'll just show you the assignment tracker, yeah? So the assignment tracker, all things considered, my break even with the covered calls and assignment put credit, 180.80. Now, I know Google is lower right now, but are we at a disastrous level? No, I'm in at 180 pretty much. I will be DCAing if it goes down into the 160s perhaps. I love the company, but there as well is a position that leads to some of the drawdowns that we're having right now. Now, moving in further. Now, moving into Grab, we have 200 shares of Grab that we got assigned at $5. We got a 20-cent credit, and now we have a 15 extra cent credit on some covered calls. Break even on this, $4.65 roughly. So we are still profitable on the Grab shares, but a very tiny position for me. Intel, we had some very good gains on Intel, almost $800 in gains, $900 in gains in Intel when Intel had a tremendous rally. These are an asymmetric bet on leaps. They are up to 27. They're now down almost 20%. So there are some of the round trip profits. We're not actually down any money. We've just round tripped some profits. Intuit, call debit spread. That is now roughly at par. We'll see what happens, but I'm bullish. I still have until April for this one. KWeb calls. KWeb calls are doing good. We closed one at a profit, $7 and something. We closed it last week. I'm keeping my 4 remaining contracts. How much time? January 2027. So although KWeb has given back some profits, I'm still very bullish on this position overall. It is not the profits that we had last week as we've pulled back 10%, and those calls have also pulled back 10%, but still. So you can see, guys, just round tripping profits. We're not down massively on any positions right now. MSCI, these swing trade shares, still roughly in or around the break-even level. I'm still bullish on this company. Microsoft, here's a big one for you. We're down $800 on this Microsoft right now. 415 short puts. We will most likely be assigned this Friday for $8 in credit. That gives me a break-even price on Microsoft of $408. And after that, I'll be running covered calls. Are we down a tremendous amount of money on that position? No, we're down 8%, or $8, which is roughly 2%. Do I mind being down 2% on Microsoft? No, I like the level, and you guys will see how I run the covered calls on these. I also have some call debit spreads, which unfortunately is showing a bit of a weird amount right here, but we're down on these probably like 70, 80%. These are for March. We'll see what happens. Using Microsoft as well. Microsoft short puts. These is the 2x leverage version, $33 puts on Microsoft. I'm DCAing. That would be Microsoft 390. If they want to come down to 33 and assign me, no problem at all. I'm getting a $33 entry on MSFU, and I have an 86-cent credit, meaning my break even is 32.15. That would be like 385 on Microsoft. I'll buy Microsoft down there. I don't care. Micron as well. Given back some of the profits we had in the last few weeks. NVIDIA, this was an earnings play for me. I had a May 16th $150 call, was looking for the expansion. Wall Street didn't give it to us. This was a lottery play. I'm still bullish on NVIDIA. We'll see. I'm willing to lose half or all of this money looking for NVIDIA to expand until May. We'll see what happens. NVO, we had a tremendous win on NVO. I had 5 call debit spreads, closed 4 of them at a very nice profit, 50% plus profit. If I can show you guys right here. I think I covered it in my weekly recap amount right there. Do I have it? Not just yet, I don't think. No, it's not there yet, so it must be this week that we just closed it. Can I see the shares in call? I don't want to spend too much time on this. I know the video is long right now, but I figured I should show you guys the positions, right? Here's the call debits. We closed one trade call debit spread on NVIDIA prior to earnings, 50% ROI. So we're locking in the profits. Here's your NVO fill right there, right? Locking in 40% ROI from our entry, closed 3 out of 4, keeping 1 overall. And here you see lottery trades. This is the NVIDIA call I was just talking to you about, right? So we have been taking profits on the ones that have been running, and we're kind of leaving the ones that are losing a bit down. SOFI, I still have 100 shares, looking to DCA 1 more at 13. We wrote those early on in the week. They might end worthless. We'll see what happens. But my average cost on SOFI right now on these 100 shares after farming covered calls and trying to DCA lower is below 15, like 14.90 right now. Are we down that much? Not even close, right? SOFI call options that I took before their earnings as a lotto trade, those are down, and that also leads to the reduction in P&L over the last roughly week and a half, 2 weeks. SOXL, we have a May 25 call here. I've been farming the heck out of covered calls on this position. I think my break even, or my average cost on these calls right now after doing covered calls for like 2 months is like $5. We've cut the cost of these call options in half. We'll see. We'll let them expand, but these covered calls will end worthless. I swear, I think my entry cost now is like $5. So that shows a unrealized loss here. We've made a ton on covered calls so far, and I like the position. SPGI, we have them 5 shares roughly at break even. SPLG, early on in the week, we wrote some SPY puts. Actual SPY puts using SPLG. That would be a 68 entry on SPLG, really close to what I was telling you guys, the almost max pain level for a SPY correction. I mean, if you're not able to buy SPY on that correction, guys, like what are we doing, right? So you can see I'm using my buying power efficiently for high quality setups only, not chasing Palantir, not chasing HIMs, nothing like that. I have a TLT hedge, which has been here since October, coming back a little bit. Trade Desk, we might get assigned 75 puts, but I like this company. We're currently underwater on this one, but all in all, I'm very bullish on Trade Desk. I'll add another contract into the 60s. And lastly, we have these square calls that we've round tripped. This is another reason for a big loss in the last week, why the portfolio has come down. You might remember these. We bought these last fall. We were up 4x on these. I closed one of them at 3x, closed one of them at 4x. We've locked in the gains. These 2 contracts are free, and we have until January for the expansion. I've also made some decent money on covered calls here, but I'm not making excuses, but this is a reason that the portfolio, that's another $1,000 in the last 1 week since the earnings. These were up about an extra $1,000, and now we have round tripped those gains as well. So as you can see, yes, the portfolio is down, but most of it is just giving back profits, some of the positions of which were already profitable and we're still in for free, other of which is just buying big tech and big tech continuing to slide. So overall, I'm still happy with the markup of my portfolio, still have a lot of buying power to go shopping for the dips, but in the future, you'll see me add a lot more value-oriented names in the near-term future. So all that being said, guys, we've realized a ton of gains this year so far. Some of the call options giving back some gains, and some of the big tech assignments just sliding a little bit more. But overall, am I trapped at poor levels? No, I'm trapped at the exact levels that I wanted to buy at, and now we'll progressively buy a little bit more and see exactly what happens. But overall, you know, yes, we've given back a lot of gains, but keep in mind, I'm running about 2-to-1 leverage on the portfolio. So that being said, that's the reasons for some of the declines, but I'm always transparent with you guys, and I like explaining you the logic behind the positions. So that is everything for today's video. If you enjoyed, consider dropping a like, consider subscribing to the channel. If you're new, we do these videos after the close to show you guys the price action and my thoughts on the matter. Lastly, if you have any questions, also free to leave them down below in the comment section. I'll be answering a ton of questions today, so feel free to leave them down below. This is the last video of the week. I know it's long, but now at least you guys have 2 days to watch the video and give me your thoughts and questions as well. And lastly, guys, if you want to have all of those trades in real time, because we've been making a lot of profits, realized profits over the course of the year so far, and I always advocate being a little bit more conservative than not. Here are all my trades since the inception of the Discord. You can see that this year, I mean, the red circles are little losses. These are assignments and these are wins, right? Since the inception of the year, we've realized a ton of profits. So now we're kind of just giving back profits, but we're not at losses. In the positions that I have, I'm very bullish on still. So these are all the wins since the inception of the Discord overall. If you want access to all these trades, the share swing trades, the short put swing trades, the put credit spreads, the call debit spreads, the call options, the leap call options, these share swing trades, and everything in between, the link to the Discord is obviously down below. We do private morning live streams where I trade live every morning and also answer your questions on stocks and your options in real time. People have been finding tremendous value from that as well. And if you cannot attend, they are obviously recorded and you can ask me all of your questions in our chat rooms and I'll be very happy to answer your questions about long-term portfolios, stocks, options, market sentiment, and everything in between. And that's pretty, many more features such as private videos where I give the high level advanced strategies for not only options, but how to grow a small portfolio. Also very high account, high balance sized account portfolio strategies that I do not show on YouTube that some of our members with large accounts have been absolutely loving. And a number of other videos that I just do not show on YouTube, more advanced stuff and much more in detail. And also you get access to all my watch lists, all my technical analysis, which is a click of a button to copy paste all the watch lists, all the technical analysis, and all the annotations. When I go through earnings like on Amazon or NVIDIA, all these annotations every quarter on over 100+ companies, it must be, right? With a click of a button, you get all the charts, the TA, the annotations, the watch list. So that's just an added benefit. If any of that interests you, the link to the Discord is down below. And if not, I'll see you back on the channel, guys. Thank you so much for watching. Hope you have a great rest of the week. Take care. I'll see you soon, and peace.